refine powerful arguments.
Today we're looking at a really bullish analysis on AMC Entertainment.
Yeah, it's focused on that Q3 2025 double beat on revenue and EBITDA. The core argument is that a big comeback is underway, driven by efficiency and that huge 2026 film slate.
And it's a compelling case. The underlying data, the revenue and EBITDA beat, that's a powerful place to start. It shows real operational health.
Absolutely. It proves they can generate cash from the core cinema business. So let's dig in and see how we can make this analysis even more impactful.
Turn that potential success into, market certainty.
Okay, so the core operational strength is clear. We've got a $1.3 billion revenue beat, adjusted EBITDA at $122.2 million.
Those are great numbers. At an operating level, the company looks efficient. It looks resilient.
But the report does mention the Q3 EPS loss of negative 58 cents. It says it was wider than some hopes.
And see, that's where I think we can go deeper. It's laid out, but it feels, it's handled too lightly, almost like it's just a footnote.
Right.
The analysis would be significantly stronger by more explicitly integrating those negative metrics, particularly that continued EPS loss, into the overall bullish thesis.
Because calling it just mixed kind of downplays the real issue. The weakness is that it treats the driver of that loss, the huge cost of capital, mainly debt interest, as something on the side.
Exactly. The report seems to be asking us to just trust that the operational strength will, eventually absorb all that financial risk once the big movies hit.
But the cost of debt isn't a footnote. It is the single biggest fixed cost that's preventing GAAP profitability right now.
It is. We have to clearly show that the $122 million in EBITDA isn't just covering operational costs. It has to cover the massive fixed cost of debt first,
before it can ever really contribute to equity value. That's the difference between a viable business and, a profitable stock.
You've hit it. I mean, if the engine is running great, generating that cash flow every quarter, but the interest payments on $2.5 billion in debt demand more than that every year, then the operational wins are basically trapped.
They're trapped under the capital structure.
Yeah. The report needs a clearer financial story that shows where that money is going. We can't just ignore the company's cost of living, so to speak.
The forward-looking turnaround, assuming the debt is just a known variable that the 2026 supercycle will just steamroll.
It's a fair question, but it's necessary to model it, because any smart skeptic is going to ask, okay, but how long until that 2026 content actually turns into retained earnings?
How long until it can actually pay down principal?
Right. If the report doesn't acknowledge the high cost of buying time, which is exactly what that debt extension to 2029 is, the whole thesis feels exposed.
So the suggestion here is to directly address how those operational positives are going to manage the costs driving that EPS deficit.
Especially with the long-term debt. We need that connective tissue, the bridge from operational success to the reality of the capital structure.
Okay, let's focus on the solution. How about adding an analysis section? Something that models how the current cash generation, that EBITDA, is tracking against the required interest payments.
Oh, that's highly actionable.
Yeah. Show the reader you've calculated the path to actually extinguishing that burden.
For concrete examples, you could build a simple model. Estimate the annual interest expense on that $2.45 billion. Then overlay the current EBITDA trend. Maybe annualize it or project it out.
And that gives you a rough timeline for getting to positive cash flow after interest. It shows you've done the math.
Exactly. It shifts the focus from here's a loss to here's the plan to mitigate it.
And the report talks up the strategic chess moves of extending debt maturities. We should probably explore the trade-off there.
We have to. That move wasn't free.
Right.
Let's discuss the assumed higher interest burden or the new costs that came with buying time. If that extension came with a higher rate, quantify that financial risk. It adds a layer of seriousness to the whole argument.
I agree. Okay, moving on. I was really drawn to the superfan economy section. It's a powerful part of the analysis.
It really is. Highlighting the record efficiency, that $12.25 in admissions revenue per patron, and the nearly $8 in F&B.
That's the foundation of the whole bull case, right? The idea that each ticket buyer is worth about 20% more now. It's the key to being viable, even if attendance is down overall.
Absolutely. But that's what makes me ask a next question. Is the connection between these amazing efficiency numbers and the future profit explosion fully proven?
Is high, profits could explode if attendance recovers.
Right. It assumes the reason for that efficiency is permanent without actually proving it.
And that's the gap.
Yeah. While the data supporting the superfan economy is a powerful foundation, the analysis has to go beyond just reporting the record metrics and really establish the long-term drivers and sustainability of this lift.
Because the weakness is that it tells us what is happening but not why. Is it just general inflation pushing up prices, or is it a real change in the business?
And without knowing that, the idea of exploding profits hangs on a potentially temporary effect that could just, disappear.
So if this is just ticket price inflation, then the whole thing could be sensitive to an economic downturn.
But if it's driven by more people choosing high-margin premium formats, that's a structural, permanent shift in how they make money.
Okay, so the suggestion is to add a focused section that investigates the source of that efficiency lift, prove it's a fundamental change, not just a temporary blip.
Exactly. We need to separate just reacting to inflation from achieving real pricing power through better products. We need proof that these gains can be repeated in 2026 and beyond.
Okay, but here's the challenge: data. The person writing this is probably using public info. Isn't granular data, like the exact percentage of IMAX tickets sold, really hard to get from the outside?
That's a critical constraint, and it means you have to get creative with proxy data.
Okay.
So if you can't break down ticket sales directly, you analyze public reports on the growth of their premium screen footprint. Or, even better, you dig into management commentary on how their premium pricing initiatives are doing.
So you build the case with correlation and deduction. Make the best possible assumption with the data you have.
Precisely. For a concrete example, let's suggest they analyze whether that record $12.25 admissions figure correlates strongly with general CPI for entertainment.
Which would suggest it's macro-driven pricing.
Right. Or is there a disconnect that implies something else, like premium format adoption is the real structural driver?
And we can do the same for food and beverage.
Absolutely. Analyze recent F&B initiatives. Did they launch new menu items? Is the loyalty program driving up the average check? If you can tie the metric increase to a few specific, repeatable operational changes, the whole argument becomes rock solid.
It moves the argument from people are spending more to management is successfully extracting more long-term value.
That's it.
Okay, let's pivot to the strategic chess moves section. The report highlights the Netflix partnership for the Stranger Things finale as a huge win.
And it was. It was a genuinely groundbreaking move. It proves that big cultural moments still need that communal theater experience.
And that AMC is flexible enough to show non-traditional content.
For sure, but I feel the analysis uses this mostly for cultural validation, for the narrative, rather than for, clear financial integration.
So the strategic value assigned to the Netflix partnership needs a more concrete, forward-looking definition of its potential economic contribution.
Yes. The weakness is that it's treated as a symbolic win, but it doesn't connect that win clearly to future revenue or margin opportunities. It sells the relevance, but it misses the profitability inside that relevance.
And that's a huge missed opportunity. Because that event proves they can use their massive fixed assets, the actual theaters, during what are usually off-peak times.
Why rely only on the 2026 blockbuster cycle if you can make money on a Tuesday night now? It should be framed as a risk mitigation tool.
That framing is so important. Using latent capacity is a big deal financially. It's about maximizing the return on your existing assets.
The argument has to shift from this proves we're relevant to this proves we have a new, scalable, high-margin revenue channel that lowers our risk.
But we have to challenge the scalability, right? Was Stranger Things a one-off, or is there a real pipeline of similar events from other streamers?
That's the key question. If the analysis can't confirm a high volume of these events, it at least needs to focus on the high margin of the ones they can get.
Right. So the suggestion is to frame the Netflix partnership not just as proof of cultural moments, but as a low-risk, high-margin diversification effort, a proof of concept.
That frames it perfectly. And to make it actionable, you have to show the margin difference.
Okay.
So for a concrete example, contrast the expected margins from hosting a special event like Stranger Things in 200 theaters versus the standard box office split for a big blockbuster from the 2026 slate.
Show that they're getting into revenue streams with potentially better unit economics.
Yes, that's a sharp distinction that adds real financial weight. And then you can go a step further.
How so?
Suggest explicitly detailing how the success of that event and its high margins could inform future revenue projections. Integrate this new revenue channel into the overall supercycle bull case.
And show that it reduces the reliance on major studios, which reduces seasonality risk.
Exactly. If this proves the event model works, it shows how they can generate high-margin revenue even when an Avengers movie isn't playing. That's a massive deal.
It makes the whole comeback is stronger than you think argument that much stronger.
Without a doubt.
So to wrap up, this analysis report is built on a rock-solid foundation. You have the Q3 double beat, the record efficiency, and that undeniable 2026 content slate. The core viability is there.
Absolutely. Our critique is really just designed to help build a more robust, defensible, and comprehensive analysis around that foundation. Address the biggest questions a skeptic would have.
We covered 3 key opportunities. First, tighten the connection between the operational cash flow and the capital structure. You need to model how that EBITDA is going to absorb the massive interest costs that's driving the EPS loss.
Second, really define the source of that per patron efficiency lift. Prove that the record numbers are from sustainable, structural changes, like premium formats, not just pricing. That makes the profit explosion argument way more defensible.
And finally, sharpen the financial relevance of partnerships like Netflix. Quantify their high-margin contribution and frame them as a scalable revenue source that